Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, it is 3 p.m. in New York. Thanks everyone for joining us this afternoon. Welcome to the webinar. Today's session will be hosted by Dan Passarelli, who will be teaching us about trading for edge with iron condors. Dan Passarelli is the author of Trading Option Greeks and the founder of Market Taker Mentoring, providing one-on-one mentoring for options traders. Dan's trading career began on the floor of the Chicago Board Options Exchange, where he traded equities as a market maker in the options pits. Dan has also traded agricultural options and futures on the Chicago Board of Trade trading floor. Dan has been featured as a guest on TV and radio and has authored numerous articles on investing strategies. So at this point, we're just going to go ahead and turn it over to Dan.
Good afternoon, everyone. This is Dan Passarelli. Thanks for that kind introduction. And we've got a lot of fun stuff to talk about today. Thanks for attending my presentation here. And let me just give you a couple little notes of housekeeping here. If you have a question during the presentation, you're not allowed to ask it. Just kidding. Please ask it, because chances are somebody else has that same question, and I really like my presentations to be interactive. And so please send me your questions during the presentation, or you can always save them till the end as well. But hey, if it's relevant during the presentation, I will answer it. I also need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. You can get a copy of that by calling my friends at the Options Clearing Corporation. Their phone number is 888-OPTIONS, cleverly enough. And I also want to point out that what we're doing here today is the ISE is kind enough to put on these educational presentations for you guys as a service to you to help you understand option trading and to help you understand how trading works so that you can be a better self-directed trader, meaning you're the person in charge. You're the one making decisions. You don't have a broker who's some stuffy old guy in a suit sitting up in an office somewhere making the decisions and trying to talk you into some sort of trade. Get rid of that clown. You guys are the ones who are in charge. And in order to do that, especially if you're trading options, you really need to understand how they work. So that's what I'm doing today. I'm helping out the ISE by being their guest presenter, trying to teach you something, trying to impart some knowledge on you so that you can take matters into your own hands as a trader. So we're going to be talking about iron condors today. And iron condors are in a family of trades called income strategies or income trades. And I'll tell you what, before I started teaching options, it's kind of funny, you guys might not actually believe this, but before I started teaching options, well, I was a trader on the floor for a very long time. I was probably on the floor in one way or another for over 10 years before I started teaching. And when I started teaching, I go up to the office where I'm teaching, and they say, okay, well, next week you can do a presentation on income trades. And I said, okay, great. What's an income trade? Now, mind you, this is after being a market maker, trading what I think most people would consider to be a fairly large account. As a professional, making sometimes hundreds of trades a day, I actually never heard the term income trade before. And probably if you ask most market makers or professional traders, they probably never heard the term income trade before either. That's a term that's kind of reserved for stay-at-home traders or retail traders, like most of the people watching this presentation. And when it was explained to me what it was, I was like, really? Income trade? That's what you call these? Income trades? That's kind of a lousy name for these. What they are is they're a family of trades. They're a family of trades that benefit from time passing. They benefit from options time decay or positive theta. But they're punished by movement. When the underlying stock moves too much, you can lose money. You can lose a lot. So that's kind of why I had this problem. What do you mean income trade? Like income, I think of income as like, you know, a little old lady in white tennis shoes on a fixed income. You know, pretty much guaranteed to get that check once a month. These trades are not really like that. Nothing's guaranteed. You can lose. And if you don't do it right, you can lose big. So you really got to know what you're doing. So pay very, very close attention to this presentation, and you ought to do better than a lot of people out there trading, quote, end quote, income trades. Now, to the point of movement punishing these types of trades, things like earnings announcements or like unemployment or Fed announcements or CPI, PPI like we're having this week, or like auto sales if it's a car company, same-store sales if it's a retailer, or like any stock where there's like something going on in it, like, you know, the market's really moving around in this one particular stock because of some sort of reason. These stocks are terrible trades for income trades. They're exactly the stocks that you don't want. You know what kind of stocks you want to trade with these? You want to trade the absolute most boring stocks in the entire world. That's right. You want to trade stocks that you think are just simply not going to move anywhere. Because then the risk part is taken care of, and the reward part, that daily stipend of time decay, ends up yours to keep and ends up working out for you. And we're going to get more into this. I'm kind of giving you a little bit of an overview here. We're going to go through some examples and such. Now, there are 4 analyses that you need to do every single time you make an income trade, or to be sure, any trade. You need to do some technical analysis. It's reading charts. You need to do a fundamental analysis, and you don't need to get too fancy with that. I'm not talking about reading the annual report or anything, although some people do. And if you earn a CPA or something and you really can take apart those numbers and put them back together again, I highly encourage you to. But if you're like most people, you got to stick with what you know. Make sure there are no expected volatility events coming. Is earnings tomorrow or next week? Probably not a good time to do an income trade or an iron condor. And then I encourage you to read the volatility charts. And we can talk a little bit about those. Volatility charts are charts that help you understand basically how cheap or expensive options are in relative terms. And you can see volatility charts at the ISE's website. So make sure you check that out. And then finally, looking at the option chain and just kind of taking a step back away from the trees and look at the forest itself and see hey, do these prices make sense for an iron condor? Now, Saeed has sent me a question. It says, well, don't boring stocks have low premiums? See, here's what we're going to be doing in iron condors. We're going to be taking in a credit. We're selling net option premium, and we want to be able to take in as big a credit as possible. But really, really boring stocks kind of have low premiums. So it's kind of a risk-reward thing, Saeed. You want to do like a low-risk, hey, everything's cool, copacetic type iron condor, then you sell a cheap one and you have a very high probability of it working out. You want to take a chance, be a little bit more of a piggy, be a little more greedy, then you sell a nice fat option premium, but the premiums are fat because the market thinks the stock might move, and you have a better chance of failure. So it's a trade-off. I mean, to be fair, you can kind of do either, but the one thing you want to do is make sure that like there's not a highly anticipated potential volatility event expected in the near future. I mean, if earnings is within a few days from, you know, the day you put on your trade, forget it. Not a good idea. So in order to understand iron condors and ultimately how to get edge on iron condors, you need to understand credit spreads. So we're going to go through a quick run through of this. I don't want to, you know, have too much preamble here. But there's two types of credit spreads: call credit spreads and put credit spreads. A call credit spread is when I sell one call and buy another call on the same underlying in the same expiration month. Call I'm buying has a higher strike price. So I kind of have two objectives here, and this is important from the edge perspective. I want to profit from theta while losing little to statistical volatility. That is, because I'm taking in a net credit when I trade a credit spread, that spread will get worth less as time passes as a result attributable to time decay. Ultimately, I'd like to see the spread be worth zero so that credit that I sold it for, you know, I can buy back for a penny or just let it expire at zero. So I want to be, and as each day passes, you know, I get a little bit of that time decay, and that's called theta. So I want to make some theta every day and not have the stock move too much, which is what causes me problems, and I'll show you why in a second. The long term, I just love to get all the theta every day and watch the stock close on the profitable side of the break-even point. So here's the call credit spread, just sort of general example. Then we're going to go through a more specific one with some numbers here. Here's the idea. I sell one call at the short strike, and I buy another call at the long strike. The up and down axis is my profit or loss. Above the horizontal line is profit. Below the horizontal line is loss. And the horizontal line itself is the price of the stock at expiration. So notice that if the stock is below the short strike price that I've sold at expiration, I reach my maximum profit potential, which is incidentally the price of the premium that I collected when I sold the spread. If we're above that short strike price, then at expiration, then I'd get assigned in my short call, and I'd basically have a short stock position. The higher the stock goes, the worse, until I get to the point where the stock is so high it's above my long strike, in which case that I could exercise that call and buy back that short stock to you know, limit my losses to the upside. So maximum profit below the short strike anywhere. Maximum loss is anywhere above the long strike at expiration. Break even is the short strike plus the option premium. Okay. Now, I told you need to look at technicals, fundamentals, volatility, and how the prices line up. here's what you look for if you're looking at a stock chart. Slow bear trend, or maybe a stock that's kind of range-bound, but it's bouncing off its resistance. Fundamentally, I don't want to have any expected news in the pipeline. Now, a surprise news story might come out tomorrow and, hey, that happens. But I don't want to have any news. I'm not trying to play earnings with a credit spread, for sure. I trade a different strategy to play earnings. Volatility, we want implied volatility to be moderately expensive. Now, the title of this presentation is, what is the title of this presentation? The Trading for Edge, Iron Condors. There is an inherent edge. There is an inherent edge by doing these analyses, by using a chart to be sure that, we're doing everything possible to try and guess that the stock is not headed higher. Granted, we could be wrong, but we're doing our due diligence. We're doing everything in our power to make sure that there are no expected volatility events. The surprise one could come out tomorrow, but we're doing everything in our power. Those things get us edge, but volatility analysis, that is what really gets us edge. We want implied volatility to be moderately, not super, moderately expensive. We do that by reading a volatility chart. Now, to really teach you guys how to read a volatility chart, that's a much longer presentation, and I've actually got a class that I'll mention briefly at the end of this presentation that I'm teaching next week that's part of a series that I think you might enjoy. It's about reading volatility charts. It's in 9 days, next Thursday. This month I'm doing a series just on volatility, and if you see the whole series, you really, really are able to take advantage of getting edge by using volatility. But here's the gist of it. And it kind of relates to what Said was getting at. Because we're selling option premiums, whenever you sell anything, you want to sell it for a lot. And implied volatility can be defined in a number of ways, but I think probably the best definition that you can use for implied volatility is how expensive options are. You don't usually hear people describe it that way, but that's exactly what it is. How expensive are options? But you need to compare implied volatility versus, well, just like a stock chart, against what it was in the past. Let's see a history of it. Let's see a chart of implied volatility. Is it more expensive now than it was, or less expensive now than it was? And you need to compare it to historical volatility. Historical volatility, that is how much the stock is moving. Now remember, I said your reward is your time decay, is your theta. Your risk is how much the underlying stock moves. Now, look, the underlying stock is going to move somewhat. It just can't move too much, particularly with a call credit spread or a put credit spread in a particular direction. We'll talk about an iron condor in a minute, but this is very relevant to the iron condor conversation. With an iron condor, if the stock moves in either direction too much, you can lose. Here, if the stock moves too much higher, you can lose. If it moves a lot lower, you can have a profit, but you miss out on bigger profits that you could have had if you did something like bought a put or some other type of strategy. So the goal is that implied volatility is above historical volatility and more expensive than it used to be in the past, and that you don't expect a move to come in the future. If you do all those things, and I appreciate, by the way, that if you've never considered volatility before, I'm throwing a lot at you. I'm trying to cram a lot into this 1-hour presentation. But it's really super important to do this. If you don't analyze the volatility and sell implied volatility, that's moderately expensive. Not too expensive, because that could be a sign of a red flag that there could be volatility coming. But moderately expensive. If you don't sell moderately expensive volatility, you're putting yourself at a statistical disadvantage. Only when you sell expensive volatility do you actually put the odds in your favor in much the same way that a casino puts the odds in its favor. You know, when you go to a casino and gamble, I mean, I'm talking about gambling. It's a little different than option trading, at least for most people. When you bet on, roulette, you bet on red. The casino has a slight edge. That's what you can get when you put implied volatility in your favor. That's how you get edge on option trade. Now, John says the higher the better. No, only to a point. Consider buying a lottery ticket. Hey, if I pay $1, I can win 100 million. Awesome. The bigger the payout, the better, right? Well, no. Because you got to consider the odds of success. You have a very, 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 very slight chance of winning. It's kind of the same thing, but a little different here with iron condors. If you sell really super expensive option premium, your chances of the trade being a failure and costing you money and being a loser increases drastically. But when it's slightly high, where it's mispriced, and I'm only giving you an overview. Yeah, I mean, to be fair, you need to learn a little bit more about this. I mean, I can give you some resources, one of which is my class that I'm having in 9 days that I'll show you how to sign up for. But there are other resources out there too. I encourage you, whether it's through me or someone else, to learn about implied volatility, reading volatility charts, which you can find on ISE.com, and using volatility to get edge. In the long run, you're going to be amazed that, it really, really can make a difference. Now, another thing you have to do that somewhat gets you edge as well, I don't think it's quite as important as volatility, but still important. And this is kind of almost a rule. I mean, most of my rules are sort of loose rules of thumb or strong guidelines. But you want a 1 to 5 payout usually, which means I can make 1 and I can lose at the most 5. Now that might seem kind of weird, like, wait a minute. Passarelli, you guys telling me I should set up a credit spread where I can lose $5 and only make 1? It doesn't sound really great at first until you consider that, well, it's really about odds. But if I ask for a show of hands here, how many people have ever played the lottery? Most of you have. Don't you know that you got almost no chance of winning it, but you still play it? Here it's just kind of the opposite. You're basically the state. You're basically the people who run the lottery. Your chances of losing are slim. Your chances of winning are great. So therefore, you're willing to, make a little per trade with the potential of moving a lot if the unexpected happens. It's called high probability trading. And when you sell these, you get a credit. Never, ever, ever, ever accept less than a 25-cent nominal credit. Just too cheap. John asks, after the entry, do you want volatility to drop or continue up? Yeah, see, this is one of the advantages of selling mispriced too high, implied volatility. Is that if it is indeed too high, it should come down a little bit soon. And if it does, then you make money not just on theta and not just hopefully on delta by the stock not moving, through your break-even point, but also on vega. I'm explaining to you a system that I teach my students on how to make money on something that most people don't even consider. And it's not necessarily always a big windfall or anything like that. It's just a little something extra to give you a little edge on every trade. Like, I talk to people all the time who say, oh, yeah, man, my commissions are too high. I'm paying, whatever, 90 cents a contract. I heard my buddies paying 80 cents a contract. Man, I wish I could save a dime per contract. That dime adds up. You know how much money I'd save? Well, that's 10 cents per trade. Could be a $3,000, could be buying an alcohol for 30 bucks, shelling out $3,000. Then you worry about literally a dime. What if you could make vega profits on every trade, on average? Not everyone. I mean, not all trades work out. We all know that. We're grown-ups. But on average, you could make a vega profit of, let's be modest and just say a nickel. Now, a nickel is not a nickel. A nickel's $5 in option premium, right? If I pay 5 cents for one contract, I give my broker $5. So making an extra nickel for every trade is way better than saving a dime or 15 cents or 25 cents or even $1 of commission. This is what I mean by edge. Now, I'm not showing you like some super system like these guys who spam me with these emails who say, oh, I've never lost it on a trade ever. I make 100% on every trade every single day of my life. That's not what I'm telling you. I'm showing you a way to take some of these income trades that are already high probability trades and put the odds in your favor so that in the long run, you should make a lot more than somebody who just kind of wings it and doesn't consider volatility. It can make a very, very big difference in your trading when you're not just profiting on theta and delta, but you're also getting in there and striving to profit from vega as well. Big difference.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.